This is Daniela Cambone, and welcome back to StansberryInvestor.com. Well, if you are frustrated with gold's performance thus far, you may not be the only one. The metal has been struggling to get back to the 2000 level that it hit last summer. But with all the fundamentals perfectly in place, what's stopping it? Joining me today is John LaForge. He is the head of real asset strategy for Wells Fargo. John, good to see you again. Welcome back.
Thanks, Daniela. Good to see you too.
So this is the million-dollar question. Everything seems perfectly aligned for gold. In fact, this is the headline and the topic of your latest penning. Yet the metal seems stuck in this consolidation phase. Why, John?
Yeah, it's been very frustrating. Anyone that's followed gold for a long time realizes the macro backdrop is about as good as it gets. I mean, how do you argue with all the money printing? We have real interest rates so low, they look like 1974, 1975, maybe 1980. You have a US dollar that may not be helping gold, but it certainly isn't hurting gold. It really hasn't gone anywhere in the last year. And yet, gold can't get anywhere. It just can't go. So what the last piece I wrote was really trying to get to the bottom of it, of your classic macro factors that should influence gold or not. So, any good researcher needs to look around and say, what's different? What has changed? Because gold's the longest living asset out there besides land. So there's lots of data to follow with gold. It should be responding, but it's not. So what's new? Bitcoin. That's probably your answer in the end is you have a new store of value that has popped up. And even though the data is really hard to track flow-wise, how much is going away from gold and into things like Bitcoin, that's hard to tell. But there's still plenty of anecdotal evidence. I mean, you have managers that come on and say, yeah, I've taken a little portion of what I'm doing here in gold, and I've put it off into Bitcoin. And frankly, when an asset does as well as Bitcoin has, yeah, it attracts investors.
So this is really interesting, John. If Bitcoin is slowly chipping away at gold's market cap, almost killing it silently, what do the next 5 to 10 years look like for gold?
Right. It depends on how you measure it, but I would have said, and I still believe moving forward, there's space for both of them. We're going to be in an environment where, let's take the US, we have 30 trillion in debt. Is that going to get paid back? How is that going to get paid back if it is going to get paid back? And the reality is, I think hard assets and long-term stores of value are going to do quite well. So, realistically, gold, has been in the penalty box for the last year. Bitcoin has stolen some of its thunder, but that doesn't mean gold's going away. I think there's plenty of room for both asset classes moving forward.
So it's interesting because some experts on the gold camp would argue this is what guys like Michael Saylor and other celebrities of the Bitcoin world wanted. If they came out enough, touted Bitcoin enough, they wanted to chip away at gold's market cap because they noticed an opportunity here. If we take that market cap, will that propel Bitcoin higher? Do you think that's kind of the plan when when they're coming out and touting Bitcoin?
Yeah, I would think the plan is more to support Bitcoin than it is to ding gold. But yeah, I think the plan with frankly is Bitcoin is, the original story of it's a better store of value than gold. Yeah, it has some teeth to it. I've been in this market for a long time too, and I like gold. So this is not a knock against gold, but there are some attributes there that are quite interesting. It's still new. It's still a technology, and it's still volatile. That's the other piece to this, is why I believe they can run together through time, run parallel, and both get their market share. Is some investors that just don't want the volatility, and anyone that says, hey, Bitcoin's not always going to be volatile, well, probably in 10 years, yeah, the volatility will die down. But in the meantime, you're still looking at a very volatile asset. And for ones that are looking for stores of value that have a little more consistency to them, I think gold will do well still.
John, when I spoke to you during our outlook, you had lowered your forecast for gold for the year from 2,300 to 2,100, but saying you were still very bullish. Today, as we're 3 months away from December almost, have you revisited that forecast for gold?
We kept it pretty much the same. We took it down about $50. So we have a target of 2050 at the end of this year. And that was hard because the macro backdrop is so good. But we're investors at the end of the day. And the way I look at the world is I combine the technicals and the fundamentals. And the fundamentals tell you how things should be acting, and the technicals tell you how things are acting. So as good as the fundamental backdrop is, the technicals have not been great over the last year. So I've just walked my price target down a little bit, just reflecting the technical reality that it isn't that great. Yeah.
But you still think we could get then to 2,000 by year end if you've knocked it down?
Absolutely. Yeah, absolutely. And I still see the fundamental backdrop as good. So I would love to see in the next couple of years the ability to take that target even higher, as long as investors start reacting to that fundamental backdrop. But they haven't so far. So
let's talk about the other commodities in the space here. I know you were liking palladium last time we spoke. Platinum, has that changed? Have you added any stars to your list recently?
I'd say the only thing I've added is less about an individual commodity and more of just the space in general. So what I've talked about for decades now is this super cycle, which has made some headwinds recently. But commodities do move through these 10 to 15 year periods where for that 10 to 15 years, they do really well. And the next 10 to 15 years, they do very poorly. I believe we're in that bull super cycle now. So Daniela, what I tell you is it's not necessarily about an individual commodity when you get into a bull super cycle. It's a little bit of, the rising tide will lift all boats. So I'd say be diversified. You don't have to take the risk of an individual commodity necessarily in a bull. In a bear super cycle, yes, it makes much more sense to be, okay, pick this commodity, not that commodity, because you don't have the rising tide. So I just say, go with commodities generally. That should be the pick.
Let me ask you this for the folks at home that are maybe thinking, hey, I want to add both gold and Bitcoin. Is there one they should be weighted more in now, or does it really depend on individual circumstances and your risk level here?
Definitely individual circumstances. Anyone that has looked at the crypto world realizes it's not the easiest thing to get into, to understand, to protect, custody. It is up to the individual. Gold has a long history of, we know how to buy the physical. We know how to store the physical. We can buy an ETF. Right now, there is no Bitcoin ETF. We're still working through all of that. So yeah, I would agree. It's up to the individual of how they feel from a custody, safety, volatility standpoint.
All right, John LaForge of Wells Fargo, thank you so much for joining us today here on Stansberry Investor.
Thanks for the time, Daniela.
And thank you for watching. We'll have much more for you, so be sure to stay tuned to StansberryInvestor.com. In the meantime, don't forget to sign up for premier access to content you can't get anywhere else at DanielaCambone.com. That's it for me. Thanks for watching. I'm Daniela Cambone.